welcome to NSE Finvest Season 6, powered by CNBC TV 18. I'm your host Gautam Srinivasan, and we are back with another episode to help you navigate the complex world of personal finance and wealth creation. Our next pit stop is in Navi Mumbai at the offices of the global conglomerate Siemens. So, let's take a look.
Siemens India is a technology powerhouse that focuses on areas of electrification, automation and digitalization. Known for its engineering excellence, innovation, quality and reliability, Siemens as a company is divided into various domains such as industry, energy, healthcare, infrastructure and cities. With over 16,000 employees, Siemens India today has around 22 factories spread across the nation, becoming one of the leaders in providing technology solutions. This week, NSE Finvest visits the Siemens campus in Navi Mumbai to engage with its techies on the theme of investing in the digital age and understanding how to make it work for a prosperous life ahead.
For me, wealth management is something like it is investing our money in a right way, in a right manner and on a right time.
The amount of money which I have, how to use it, how to grow it, and if it diminishes, then again how to pick up and again how to reinvest it. That's what financial literacy means to me.
Financial literacy to me means having an understanding of how, when and at what stages one must invest and what one must know with regards to the risk that come with it.
Financial literacy for me is getting aware of your portfolio, what you are earning and how you are going to invest that money and how you are going to utilize that money for your monthly expenditures.
Welcome to NSE Finvest Season 6, powered by CNBC TV 18. Our next pit stop here in Navi Mumbai at the offices of Siemens to meet with the professionals here who have all the questions regarding financial planning and wealth creation to ask, and of course to answer them we have with us two financial planning experts, Gajendra Kothari and Hemant Rustagi. Gentlemen, thank you so much for joining us, and thank you to the audience for joining us as well. So we've got a good exchange of ideas coming up, and remember, investing in yourself, your path to prosperity, that's the theme of NSE Finvest Season 6, and we're going to start with that before we move on to the main topic. Tell us about the investment philosophy someone should have. We have a mix of folks who have already invested in funds, and we also have some who have not yet started. But the core philosophy that should underpin all investments, what do you think that should be?
The idea is we all have goals, 4 or 5 financial goals in mind. Can we achieve those goals in a very peaceful manner? That's the philosophy which we should really think. So the idea is very simple. What are these goals? List out these goals and make sure that you put priorities, right? Which is your number one priority and number two, because most of the times we may not be able to achieve all the goals at this point in time. And there are these wonderful online calculators and online plans which can tell you that how you need to travel over the next 10-15 years to reach these goals. The third thing you have to ask yourself is what kind of investor you are. Are you an aggressive investor or a conservative investor? So the two things which is really required from your end, more than anything else, is discipline and patience.
All right, and taking forward what Gajendra has mentioned, we now have a whole lot of options to choose from. Technology has kind of democratized investing in a sense versus say 20 years ago. Outline them for us in terms of how the people who are investing can look at the money that they have and figure out what to invest and what to save. What do you think that should be?
When we talk about different goals, our requirements are different. Somewhere we want to build capital, somewhere we want to have safety of capital, somewhere we want a bit of both. Your portfolio should reflect that. If there are any gaps in what the kind of portfolio that you create and what you want to achieve, there are going to be disappointments. Now, for example, if you want to build corpus for your child education, which may be 15 years away, or you want to build corpus for your own retirement, which could be 20-25 years away, and you build a very conservative portfolio, because what happens is we generally look at safety of capital. Now, the moment you look at safety of capital, you are building a gap between what you can achieve from your portfolio and what you ought to achieve. So I think it's very, very important. If the objective is safety of capital, go for debt. If you want to build capital over a period of time, go for equity. It's equally important to choose the right option. Make sure that your asset allocation is in place. Even when you're investing in debt, instead of looking at fixed deposit, look at debt funds or mutual funds, because there you get tax benefit in terms of indexation if you keep money for 3 years. So that will ensure that your post-tax returns are much higher. So I think it's very, very important to identify what you want to achieve, build a portfolio in a manner that there are no gaps in what you want to achieve and what you can achieve from your portfolio. I think that's the way to go forward.
Right, and you mentioned earlier about investment equating to different levels of rights. Some are from for the strong of heart and some are for the average investor. So give us some do's and don'ts of determining a risk profile when someone looks at the money that they have and the way they can deploy it into different investment options. What sort of questions should they be asking themselves to determine their risk profile and, the investments concurrently?
First and foremost answer is, risk and returns goes hand in hand. If the risk is high, the returns expectations can be higher. And if you don't want to take risk, expect low returns. Anything which is beyond fixed deposits, 8-9%, it has to have volatility. Now, volatility doesn't mean risk as such. Volatility only means that your capital can go up and down. All I'm trying to tell you is that this is something which you'll have to figure it out yourself. Either you can do it online or sit with your advisor, because he will have certain framework. See, when we go to a doctor diagnoses us. He will ask us 20-30 questions, right? Only then he'll be able to find out what is your ailment, and then he gives you correct prescription. The problem, straight away we jump to investing. Most of the time when I meet a investor, he says, okay, kitna return milega? That's the first question they ask. Without even answering that, what is my requirement? How long can I invest for? If the markets tomorrow go down by 10%, am I comfortable?
That's always a habit which is hard to curb, which is timing the market, especially when it comes to lump sum investing, right? People, if they have a sort of a corpus of money, they always think that I should wait for a market correction before deploy. How do you address that question?
Now, the issue is when you have a lump sum to invest, there are two questions that you need to ask yourself. One, how long this money has to be invested, because that will decide what kind of asset allocation should you have. Second is this going to be my only investment for a long time? Basically, what you do is you follow something called a systematic transfer plan. Systematic transfer plan is the similar concept, but it's suitable for someone if you have a lump sum money, but would not like to invest the entire sum at a particular level. So what you do is, you decide which equity fund, for example, you want to invest in the liquid fund of the same mutual fund, give direction to the fund houses that, okay, X amount should be invested on this date into this fund. So what you're doing is, then you're following exactly what a systematic investment plan does for you. Another option could be, depending on the time horizon that you have, or whether the probability of continuing this investment over a different time period, you can do a bit of both. Maybe you can invest 30-40% as lump sum, and the rest can go as to systematic. So because what it does for you, if the market goes up, at least 30% of the investment has been invested at a lower level. If the market goes down, your 70% is going at a lower level, and it also gives you the flexibility that in case there is a sharp fall in the market, the money which is likely to go for the next 12 months or 18 months can be invested.
All right, it's time to take a short break. Stay tuned. We'll be right back here on NSE FinVest Season 6, powered by Cnbc TV 18. Welcome back to NSE FinVest Season 6, powered by Cnbc TV 18. Now, in the previous segment, we had a broad discussion on investing in yourself, your path to prosperity. In this segment, the topic is more focused, which is investing in the digital age. So, gentlemen, let's get right to it. How has the digital age made investment more easy? Could you outline a few of the developments which have happened, which some of the folks here might not know?
Both for direct equity investing as well as mutual funds are concerned, you have these wonderful apps with amazing designs and look and feel, okay, wherein you can put your goals and you can answer these few questions on your risk profiling. It tells you that how you can go about in achieving these goals. And if you're good to go, you can start your investing right with as low as 100, 500 rupees. The flip side of that is, because now everything is on the fingertips, we become impatient. We would like to check our portfolios on a regular basis. Today market has fallen by 300 points. You would like to see what impact it has on your portfolio. That's not good, And because you have those two buttons right there, buy and sell, you tend to press it immediately, We have seen people stopping their SIPs in 6 months' time. I'm sure few of you would have done it in case you've gone direct way. without taking help. That's the flip side of digital age. But if you can control your emotions, I think technology is a wonderful tool. It makes your life much easier.
Right. And Hemant, what are the mistakes to avoid? The technology affords us a vast investment universe. It makes it more accessible. But there is, again, as Gajendra had mentioned, there's the flip side that you're always on a hair trigger as to whether to buy or sell quickly.
There are a couple of issues where, one, the investor can go wrong, and what digital world does not offer you. Where we can go wrong is, like he already mentioned, that we become a little impatient. We think that, wow, it's very, very simple to now invest and also stop investing. What we need is, through the investment process, we need hand-holding. We need someone to tell us that, look, it pays to continue investment through the volatile period. Now, when I'm sitting all alone in front of my computer or in front of my mobile, the way I find it very easy to invest, I find it very, very easy. I can be a little depressed looking at my portfolio saying, look, I think I've done something wrong. I don't think this is not working out for me. So let me just stop investing money. Second is that we may actually be driven by what's happening in the market. So suddenly then everyone is talking about equity market. I'll say, okay, let me start SIP. And I'm not doing it in a planned way. So there are chances that you may end up having 10, 15 SIPs.
And the role of the financial planner itself, as we go into a digital age and more options become open for people to go in directly, and direct plans are an example of that. Tell us about how the role of the financial planner will change in this digital age, because there will be more expectations from the average investor.
You know, as you get more and more options, product options and feature options, that much confusion is going to prevail. And markets are going to become even more volatile going forward from here. And that is where you require hand-holding. The way he does advice can be over Skype or online. You know, he may not meet you physically, but there is somebody out there whom you can pick up a call and can ask questions maybe at 12 o'clock at night. The problem only with technology is that, you know, it's a one-way communication usually. And many times, you know, Gautam, we require multiple conversations, you know, within a short span, which is where the role of advisor is there.
All right. On that note, let's see what questions the audience has on this topic of investing in the digital age. First name I'll be calling out is Thomas, if you could get up.
Based on the focus topic that we have for today, what I wanted to see, first of all, part of it is already answered when you mentioned of these apps that are there gathering this data. And how can I use it basically to predict my future?
Too much analysis also leads to paralysis. So what I'm trying to say is that don't see on a quarter-to-quarter basis that, you know, how your fund is doing. If you have bought into a fund, give it 3 to 5 years and just make sure that has the fund beaten its benchmark, which is Sensex or Nifty. Okay. And as far as the category is concerned, in that category, is it average? It can never be number one all the time, but as long as it is average, as long as it is within the benchmark, you should stay and remain invested.
I hope we have answered your question, Thomas. Thank you so much for asking. The next name I'll be calling out is Anita Matta, if you could get up.
I would like to seek advice on how to keep a balance in investing in various sources so that so that all the eggs are not in the same basket.
You know, for any investment, to build the portfolio, the most important part is asset allocation. What asset allocation does is basically allows you to invest in different asset classes. And the reason why it is important is because different asset classes behave differently over different time periods. So when you invest for the long term, for example, you know, you have time on hand. You can live with the volatility that comes with the investment in equity. And because you have a long term and because you're investing systematically, the impact of volatility in the portfolio is not only reduced, but you actually benefit from that. How do you decide how much money should go into equity, how much should go into debt? Yeah. Now, one way is obviously to do your risk profiling. And the risk profiling can also be done from your time horizon. Because the moment I know that I have 15, 20 years to go, or 10 years to go, or 5 years to go, or 2 years to go, that helps me decide whether I'm in a position to take volatility risk or not.
All right, let's pick out a third audience member to ask their financial planning goal. Divya Venkatraman, if I could request you to get up.
I haven't really mapped a goal. I just want a corpus of, say, 1 crore in a time period of 5 years. The amount that I'm looking to invest is somewhere between 25 to 30,000 per month.
Go with hybrid equity funds, not fully equity, wherein you have anywhere from 30 to 60% equity exposure and the remaining being debt. So it gives you a balanced, portfolio. And there you can expect around 10% return over a 5-year period.
All right, I hope we've answered your question. Thank you so much for asking. On that note, we'll take another short break, a very engaging discussion on investing in the digital age with a lot of interesting questions being asked by the audience. When we return, the floor would be open to the employees here at Siemens to ask any questions that they have to our financial planning experts. And remember, you can stay updated with us on our website, nsefinviz.com, and of course our Facebook and Twitter handles at NSEFinviz. Stay tuned. We'll be right back. Welcome back to NSE Finviz Season 6, powered by CNBC TV 18. Well, the floor is open to the employees here at Siemens to ask any question on financial planning and wealth creation to our experts here. So let's see a show of hands. Who would like to ask a question to our experts? The gentleman here in the blue shirt, if you could get up.
Market risk and the credit risk, which is unknown to us, how can we make sure that these are also covered in our financial planning?
When you are investing on your own, normally you would end up having a concentrated portfolio. And it requires a different kind of monitoring because you need to make sure that the impact the international, domestic, political, geopolitical, economic events are having in your portfolio, and you should have the wherewithal and the time to actually make changes in the portfolio. And if you don't exit from them or don't take corrective action, you'll actually end up losing a part of capital that you have built over a period of time. So, my advice to you would be, one, choose the right asset class and choose the right method of investing or right vehicle rather. Go for mutual funds. Even through the mutual fund, you can build the kind of portfolio that you want. So third thing is choose the right fund. Go for the fund which are very, very consistent vis-a-vis the benchmark as well as the peer group. So if you look at these three things, I think you should be able to handle the volatility very well and stay committed to your time horizon.
All right, let's see some raised hands on questions that you'd like to ask. The gentleman there in the check shirt.
I want to know which one is the better instrument for retirement purpose, NPS or equity-oriented mutual fund?
NPS is a fairly simplified vehicle, wherein up to 2 lakh rupees you can save taxes also. So 1.5 lakh comes under Section 80C, where you have competition from PPF and ELSS and other things. You have another 50,000 exclusively for NPS, which I would strongly recommend you anyway do it, that 50,000. There also, because you are young, you can choose the most aggressive asset allocation there, which is like high on equity. It can go up to 75%. You can choose a mix of equity, corporate bonds and government securities. Now, the beauty with NPS is that it's very low cost vehicle. The expenses in NPS is absolutely negligible. You're hardly paying anything. In mutual funds, when you invest in an equity oriented fund, you end up paying around 2.25% per annum expense ratios. The problem with NPS is that NPS doesn't give you too much options. It doesn't allow you to choose mid and small cap funds or maybe some high risk fund which a mutual fund allows. Because you have a time frame and if you understand and you can take more risk, that is where mutual funds help you. And that is why I said some portion of your portfolio can be in NPS, some portion of your portfolio can be in mutual fund. See it over a 3-year, 5-year period of time. You will then yourself be more comfortable that which way to tilt more.
What is still negative for NPS is one, the compulsory annuity after you retire, the 40% of it which you have to buy annuity. We all know that return on annuity is very, very low and they're also taxable. So I think that doesn't give you the flexibility of deciding what to do with your money, and also your post-tax return also goes down. The second problem with NPS is that even though it allows you to invest 75% today, when you become 50, reach the age of 50, you start reducing from there. I believe that that's the right time, the best time for you to increase your allocation to equity, because by then you would have kind of taken care of all your responsibilities or liabilities then. So I think these are still two issues with NPS, even though I would say that one, you have additional 50,000 tax benefit there, and the second is that now it has become 100% tax free vis-a-vis a mutual fund where you still have to pay long-term capital gain of 10%.
All right, I hope we have answered your question. We have time for one more. Anyone with a question? The gentleman there.
When we get in touch with any fund manager, this financial planner or financial advisors, how much trust we can put on that guy?
Okay.
And second thing is like we have a goal for retirement or child's education and foreign trip. But one thing is like what I believe is for the health for ourselves and our family. So any percentage of the portfolio that we should keep aside for health, because nowadays the health issues are going more and more, and the cost of health is also going more.
My view is that even when you have an advisor to help you, okay, your role doesn't end with selecting one advisor and forgetting about it. You as an investor will always have an active role to play. You may not be very well versed with different options and how to analyze, but once you involve yourself in the process, you will start learning that. You'll start asking the right kind of questions. If you want the best out of your investment advisor, you need to remain alert. You need to continue to participate in the process so that you learn over a period of time. I mean, you just can't depend on one person to say, okay, I have an advisor, now you do whatever you feel like, I'm here only to sign. I think that's the first thing. Health insurance you talked about, I think it's very, very important that you are adequately insured in terms of health. That's one aspect generally we ignore. So I would say, again, you need to also choose the right policy for that. If you have elderly people, you need to buy individual. If you have young family, then you can buy a family floater. It depends on the number of members you have. But generally speaking, if you have, let's say, 3 or 4 members in the family, minimum health insurance should be at least 10 lakh rupees. So you make sure that you're adequately insured, and there are so many plans which are available for you to buy. Once you've taken care of that, it does not disturb your investment. So in case you have an emergency fund, without disturbing your long-term investment process, you will have money available for any financial exigency that may arise.
All right, on that note, we will wrap up this exchange of views. I'd like to thank the employees of Siemens here for joining us and, of course, asking their questions to our financial planning experts, Gajendra, Hemant. Thank you so much for joining us. And, of course, thank you to our viewers for tuning in. You can stay updated with us on our website, nsefinviz.com, and, of course, our Facebook and Twitter handles at NSEFinviz. Keep watching CNBC TV 18.
The event was fantastic. I mean, there was great insights from the experts, and the type of engagement levels from our employees actually broadened the entire scope, and I think the learnings were huge, not only for short-term but for long-term investment planning.
A lot of times we think that we know most of what we are doing, but today I got to know some very interesting points, especially where we have to focus more on ourselves rather than we focus on other things that are seemingly priority in life. But if we don't focus on ourselves first, then of course the other priorities don't work.
This is one of the first kind of a session that I have attended, and definitely one learning that I have received is I definitely need to have some kind of a goals in my mind and put up different buckets and what are the best options that we should invest.
Session was excellent actually, because even I used to scare with the investment stuff, but it really helped me out to go ahead with this.